Hi, everybody. It's a pleasure to have you join the session. Today, we're going to be covering the year of 2022, and we'll do an extensive review of what factors have influenced us and what have impacted the market in general. Looking at a quick agenda, SENNDER has released a look back for 2022, just like for the years previous to that, and it contains a perspective of several key themes of last year and how shippers have been impacted and how carriers and the road freight in general has been impacted. And we will also use that time to sort of look into 2023, what is going to happen this year. I'm looking forward to touching upon sort of the key sections of this report. Before diving into things, I'm not here by myself. I've got Nick on the call. Nick, why don't you start off with a quick introduction?
Thank you very much, Julius. So Nick Fraser, I sit in the strategy and planning team here at SENNDER. I run our industry insights team, and I'm also responsible for our network strategy at the company.
Fantastic. Thank you, Nick. And I'm Julius, one of the co-founders of SENNDER, together with Nico and David. And it's great to host this call today. Now, kicking things off with the first section, the market overview. I think we should at first look at the cost evolution. If we jump to the next slide, how has that sort of developed? I think it's clear to say that we had a cost peak in the beginning of June of last year, which was actually over 10%, 13% specifically higher than the previous year. Now, looking at the graph, you'll see two lines, an orange line as well as a gray line. Now, let me elaborate what these actually are. Starting with the orange line at the top, it's a SENNDER cost base evolution index to 100 in January 2022. And below that, we've got the gray line, which is the Timocom barometer, which basically is a ratio of trucks versus loads posted on the Timocom, which indicates the market capacity in general. It's a value of 76 here in January 2022, which basically means for every 100 posts on Timocom, 76 loads 76 were loads looking for trucks, and 24 were trucks looking for loads. Now, overall, I think it can be said that it was a year of two halves. First, costs peaked in June, as I shared, which were 23% higher than January due to two factors. First, we continued to see a capacity tightness in the market as a result of the residual demand unwinding from COVID lockdown and continued driver shortages. And second was a spike in the fuel costs resulting from the Ukraine conflict. We touched upon this in more detail on how the diesel developed, but these are sort of the two key factors. Secondly, there's a gradual decline in the prices due to two factors unwinding in the second half of the year. First, order books were falling off. July onwards marked the point at which the PMI, the Purchasing Manager Index, flipped, and purchasing managers indicated that they were experiencing and expecting market contraction of the business. And SENNDER had actually noticed from the market in general a uptick in inbound requests for carriers looking to fill their trucks and looking for loads. And this trend actually now continued in the first months of 2023. And second of all, fuel costs evaluated, but came down significantly in Q4, by about 15%. Now, not all lanes and geographies are the same. If we look at, for example, Germany to Poland specifically, I think it remained flat as a weakening Polish economy suffering from high inflation offset the rise in fuel costs and capacity shortages from Ukrainian drivers returning home. And then second of all, the domestic German market continued to be one of the most capacity constrained markets in general. Despite a mild manufacturing contraction, the first half of the year, which was at 0 or negative 0.2, 0.3% growth in Q1 and Q2 respectively, fuel prices and shortages of drivers pushed rates almost 40% above January and July before coming back down at an 18% increase in December. Moving on to the next slide and looking at the spot market and the spot opportunities specifically. As markets have fallen, the spot bubble had burst. And if we look at H2 of 2021 and H1 of 2022, it was a highly profitable time for asset-based carriers. Structural factors such as driver and truck shortages provided fertile ground for historically tight market conditions where external shocks kicked off a vicious cycle. Port congestions and shortages, which resulted in delays in ocean freight, led to a lumpy production, making it difficult for contract carriers to effectively plan, and orders being placed further in advance, placing greater stress on the entire ecosystem. This led to more spot opportunities and higher spot prices as a result. Logistics contracts remained relatively toothless and easy for carriers to reject agreed volumes, leading to spiking spot rates caused or resulted in a decline in service quality and high contract rejection rates for many of the carriers. And the loop just continues as all backed up by, or as everything was backed up by heavy demand for freight, which fueled the speed of the cycle. As external shocks and demands have diminished over the second half of the year, the vicious cycle effectively reversed. Now, spot opportunities in December of 2022 fell to 43% of December 2021 levels. So 43% of December 2021 levels. Seeing pockets of activities across the markets where spot prices are now below contract volumes. Typically, shippers reconsider pushing volumes back to the spot market if prices remain more than 10% less than the contract volume. Carrier service quality much improved across the business in general. Given structural constraints in the market, driver shortages and regulation specifically, we do not expect the market to continue to fall as dramatically. However, it will be highly dependent on the speed and on the scale of any recovery. Now, Nick, over to you to look at sort of the key themes of 2022 and the impact of Russia and Ukraine specifically.
Thank you very much. So yes, one of the biggest exogenous shocks to the market was Russia's surprise invasion of Ukraine in February. And to shed some light on the key impact for the road freight market, we are focusing on the immediate shipper and carrier impact. So if we jump through, here we can see that the war has really put Ukraine firmly on the map in terms of the sheer volume of commodity items that have been produced by the country and the impact the disruption has had on these markets. So we've highlighted the top 4 categories of commodities here on the left, and these represent around 60% of Ukrainian exports. Ukraine is around the 7th largest iron ore producer and the 10th largest wheat producer globally. And all these commodities have typically followed the pattern that we can see on the right-hand side. So we had this initial sort of market price spike as the markets panicked. We weren't sure about the future. And then this kind of reversion to the mean over the second half of the year, as we've had a combination of other producing countries increasing their output, or in the case of wheat, Russia providing a safe passage of goods to be exported. We've found particularly that steel producers have found 2022 a really tough year. So we've had energy and ores significantly depressing their margins. and that's a large part due to this conflict. The message from SENNDER is that although these prices are largely back down, they're incredibly vulnerable to further shocks externally or within Ukraine and escalations in the conflict. So as well as commodities, Ukraine is also responsible for key manufacturing parts thanks to its low labor and operating costs. So earlier in the year, for instance, we saw this lack of wire harnesses in March and April, causing production shortages in several automotive OEMs such as MAN, VW and BMW. And we know that shippers who are impacted have been diversifying away from Ukraine to reduce this risk further, but it still maintains a risk factor for many shippers. So if we look at kind of the Russian front and the Russian trade front, there's been a real collapse in non-mineral fuel exports and imports. So this graph is only up until September because data has been harder and harder to come by due to Russian restrictions. But in general, shippers have been reducing exposure both in their supply chains as well as Russian domestic operations, where the likes of Adidas, H&M, Unilever, and Shell have sold, suspended, or ceased activities in the Russian domestic market. We've also seen the impact of EU sanctions on items like iron, steel, wool, cement, oil imports by sea, and coal. And we anticipate these trends to continue as sanctions increase. Shippers move production away from Russia, and Russia itself also pivots away from the EU and more towards Asian and Middle Eastern markets. Now, on the carrier side, there's kind of a primary and secondary impact that we want to highlight. So on the primary impact side, we know that there are around 105,000 Ukrainian drivers employed in international transport in Poland. So given Polish access to the single market and Polish carriers represent around 30% of the European market, this is obviously having a big impact on the rest of Europe when tens of thousands of these drivers have returned home. So internally, we've had some anecdotes from stories of our carriers where they've left trucks in car parks as the drivers themselves rushed home to kind of defend their country and leaving their truck alone. Overall, this impacted the market, leading to capacity tightening around 10% from February to May. Now, on the secondary side, larger carriers face political pressures to distance themselves from Russia. So in March, Koehler announced plans to sell off its Russian business. Kuehne sold its Russian operations in July, and DHL have suspended Russian shipments indefinitely. In April, the EU also implemented a ban on Russian carriers in Europe, and this was mirrored by Russia in October. So this combination of increased driver shortages, sanctions, and avoidance of Russian business by large carriers therefore created like huge profit opportunities for carriers who were willing to make that trip. We know that rates from Germany to Russia increased by more than 3 times from January to July, and in many cases, much more than that. So the other impact of Ukraine, but more generally, is fuel prices that we all kind of know have risen a lot over the year. And our belief is that fuel prices are structurally vulnerable to price increases if demand allows, regardless of what happens in Ukraine. So similar to the commodities, we had this initial price shock following the invasion, with oil prices rising to as much as $123 per barrel in June, and then a decline as global demand falls off and the European price cap is implemented. On the right-hand side, we can see diesel prices, and we can see that it's much, much stickier in its price level despite the decline in oil prices. We've got some different countries here in terms of diesel prices, and these differences in prices reflect different government tax policies and subsidies that have been put in place to help mitigate the impact of the oil price rises for transport companies. Diesel still accounts for around 27% of total carrier cost in Germany, according to the ILTV, although there is some resilience from carriers in their ability to pass off increases in oil prices thanks to fuel surcharge mechanisms and spot pricing. So in 2021, Russian exports accounted for 25% of European oil demand. And our view is that oil prices would have likely risen in 2022, even without a conflict, due to structural underinvestment in global oil supplies. And this is something that is still plaguing the market. So refining capacity is challenging to bring online quickly, and there's been a lack of investment in new oil production, given environmental, social, and governance targets of major global investors. So on the left here, you can see a pervasive decline in global oil and gas upstream investment. And on the right-hand side, you can see that for the last few years, we've been consuming more oil globally than we've been producing. And this is likely to continue given the challenges of ramp up and underinvestment. So what we're saying is that although prices have declined, any uptick in global demand, and I'm particularly thinking about recovery in Europe as well as China emerging from COVID, will immediately push back up the price of oil. So we're in a very kind of delicate, volatile state right now. We also wanted to highlight some interesting ING analysis on the shipper impact of increased fuel costs, so not just oil, but also gas. Aside from rising transport costs, these energy costs have severely impacted manufacturing operations this year. And you can see some of the big users of energy that you might expect here. So Germany as a country in particular, a large part of their kind of business model has been to import cheap commodities and energy from Russia and the East, convert these into premium high quality finished goods to export elsewhere. However, high gas and energy prices are making this increasingly unsustainable, and this is a trend that we think will continue for shippers over the next few years in Germany and other parts of Europe. So BASF, a German chemicals company, announced plans to permanently downsize its operations and open up business in China as a result of these trends. There's also a large number of industries highly reliant on the energy usage sectors. So if you take food and beverage, a key sector for us at SENNDER, it's highly dependent on agriculture and other energy-heavy inputs. And the ability of these dependent industries to pass on fuel price rises is very mixed and really dependent on their market power and existing margins. But just kind of to flag, it's not just those immediate energy uses that will be impacted by these high costs. Now, moving on to a more broad macro view, inflation has been at the top of our shippers' minds, along with concerns of interest rates and the resulting falls in economic activity. So the outcome of the war in Ukraine leading to high energy and commodity prices, also strong consumer demand and supply chain bottlenecks led Europe to its worst inflationary period since the creation of the Eurozone. Energy price inflation accounts for around a third of overall inflation in the Eurozone. So what that means is, although it's been a big factor, there have been other factors at play as well. Inflation has been particularly bad in Eastern Europe, with the Baltics and Poland close to or above 20%. And Western Europe has not fared much better, with the exception of France, which has rapidly expanded government subsidies to prevent the impact of price rises, and Spain, which has fared better due to relatively limited reliance on Russia for its energy needs. As a whole, though, high inflation rates have led to sharp falling consumer confidence, which hit all-time lows in September, and the ability to spend, or consumers' ability to spend as disposable income is squeezed. Now, to contain this, the ECB has made a series of interest rate hikes, with more likely to come. And interest rate hikes both raise the cost of borrowing and servicing debt. So again, that's more pressure on consumers with mortgages and more expensive for businesses to make investments. Okay, now, when we think about the impact for shippers and the outlook for what's likely to come, we wanted to highlight a study on durables and non-durables in the Great Recession. So that's that 2008-2009 period. So durables can be defined as consumer or industrial goods that can be used for 3 or more years. So a classic example is like a brick used for construction is an infinitely durable item, but also other kind of big ticket items such as cars. Now, historically, durable goods, so that's the orange squares on the graph, tend to experience the biggest decline during the early parts of recessions as consumers feel uncertain about their future spending ability and businesses don't want to invest in that uncertain environment. And then the flip side, as we can see on the right, is that these durable goods tend to bounce back fastest in the recovery. So what does that mean specifically in terms of a sector? So food and beverage, very much a non-durable industry and produces essential products. That means people still need to eat. And so it typically holds up well in a recessionary environment. So we can see here in the last 2 recessions, although the industry has slightly contracted, it's done much better than wider GDP growth. That's not to say that all shippers and channels are the same. Out-of-home spending may shift more towards in-home consumption, for instance. Now, at SENNDER, we've seen an interesting pattern. So we've looked here at this like-for-like lane combinations. So that's same shipper, same lane at SENNDER. And what we can see during the first half of the year, when kind of the going was good, we had a rise across major industries. We had, with the exception of e-commerce and other manufacturing. And then in the second half of the year, we saw a decline, particularly strong in metal product manufacturing, an industry, as I already mentioned, it's been hit hard by both energy and raw material costs. Food and beverages, that's that top dark line, remains kind of very much in a strong position, and we kind of anticipate this trend to continue. Now I'm going to hand back over to Julius to run through the future of green.
Fantastic. Thank you, Nick, for your insights. Now, looking at the market of green fuels specifically, it's been a huge topic, as it's very dear to the hearts of our shippers, and it's one of the key priorities for the future. And at the same time, it's also very dear to me as and the organization in general. Now, longer term trends to consider are the introduction of green fuels in general, the electrification of the transportation segment, and the increasing importance of shippers to place on on their shipments, to place visibility on their shipments. Now, jumping into the first slide of the green fuel section, legislations as well as general economics both push towards a greater and greener fuel adoption going forward. As part of the new Green Deal in 2021, the EU committed to a 55% reduction of greenhouse gases by 2030 and a zero net car emissions by 2050. In February specifically, the EU agreed to rules ensuring zero emission vehicles be given discounts on at least 50% of road tolls by early 2024. If we look at the road tolls of our carriers, it makes up roughly 25,000 euros per truck per year. So it's huge. And if we look at an emission trading system for transport, for the transport industry, which will be phased in between 2026 and 2028 specifically. Although diesel trucks will still be allowed beyond 2030, there will be an encouragement of electric trucks for short distances or short distance journeys, for example, 300 kilometers and below, and hydrogen trucks for longer distances. In the short term, the use of alternative fuels such as HVO, which we use today, is an easy way to reduce emissions without capital investment. Specifically, it actually reduces CO2 emissions by over 90% versus standard diesel vehicles. And these fuels allow carriers to differentiate themselves, potentially increasing margins, and be eligible for more tenders with forward-thinking shippers. Now, beyond HVO, electric trucks will inevitably be the future of road freight logistics. Transport and Environment, a clean think tank, commissioned an independent report on the point of which battery electric vehicles would beat diesel engines on a total cost of ownership basis. This is on the right-hand side, where we can see we're not far off a step change in the way electric vehicles may become more economically viable for more kind of trip types in general. Now, looking at this forecast, it assumes sufficient charging infrastructure is in place. So therefore, it is anticipated that the adoption of electric trucks will be much slower than this. And PwC actually estimates by 2030, 1/3 of all trucks in Europe will be electric. So it's huge, and there's huge upside potential of it. Excellent. Now, this was a brief summary, a very brief summary of the full report, and we'll go into much more detail in the version that you can actually download. And we also cover sections, if we jump to the next slide, such as COVID and the big impact of China, the truck production, as well as the semiconductor availability, as well as the driver shortages and how they impact the industry in general. So be sure to download the entire report to get more details on the market development in 2022, as well as the 2023 trends. And I think, Nick, we can close it here, right?
I think we can. Thank you very much for your time.
Thank you, everybody.